In the ever-fluctuating landscape of the stock market, one rule stands out amidst the chaos: don't panic. When the market takes a downturn and your portfolio sees a significant decrease in value, it's easy to let fear take the reins. But amidst the uncertainty, it's essential to maintain composure and stick to a well-thought-out strategy. In this video, we delve into why panic selling is often counterproductive and explore key steps to navigate market downturns with confidence. Join us as we uncover the wisdom behind weathering the storm and emerging stronger on the other side. Before we tackle everything, join us on Everyday Elevate, where we dive into the depths of market volatility and emerge with strategies for success. Don't let fear dictate your financial decisions. Subscribe now to stay informed and empowered in navigating the stock market's ups and downs. Let's elevate our understanding and approach to investing together. First things first, keep calm and ensure you have a well-defined strategy. In times of stock market decline and consequential portfolio depreciation, it's common to contemplate a swift exit strategy. The inclination to seek immediate action, such as withdrawing investments, is understandable, particularly when faced with financial uncertainty. However, the prudent approach involves refraining from impulsive decisions and instead adopting a strategic mindset. Rather than entertaining thoughts of reactive measures, it is imperative to inquire, what actions should I refrain from? The unequivocal response to this query is to avoid panic. Panic selling often emerges as the instinctive response during market downturns, precipitating adverse outcomes for investors. To navigate these turbulent waters effectively, it is essential to pre-establish your risk tolerance level. Understanding the potential impact of market volatility on your investments is paramount. Moreover, implementing a diversified portfolio strategy serves as a potent risk mitigation tool. Diversification entails allocating investments across a spectrum of asset classes, including those exhibiting minimal correlation with the stock market. This approach serves to cushion against market fluctuations and, consequently, minimizes potential losses. Therefore, when confronted with market volatility and the allure of impetuous actions, maintaining composure, evaluating risk tolerance, and embracing portfolio diversification are indispensable. By adhering to these principles, investors can confidently traverse market uncertainties, positioning themselves for enduring financial stability. As investors, we all recall our initial encounter with a market downturn. For those new to the game, watching the value of their portfolios rapidly decline can be quite unsettling. That's why it's crucial to grasp your risk tolerance before you start setting up your investment portfolio, not when the market is in the midst of a frenzy. Your risk tolerance is influenced by various factors, including your investment horizon, financial needs, and how you emotionally react to losses. Typically, it's evaluated through questionnaires available on many investment websites. These free online tools provide insights into your comfort level with risk. One effective method to gauge your response to market fluctuations is by experimenting with a stock market simulator before diving into actual investments. By using virtual cash, such as $100,000, you can observe the ups and downs of the market firsthand. This hands-on experience allows you to assess your unique risk tolerance and better prepare for real-world scenarios. Understanding how the stock market operates is essential for making informed investment decisions. This knowledge equips you to navigate unexpected downturns and determine whether it's wise to adjust your investment strategy. It's crucial to be prepared for the possibility of losses and to establish a robust strategy to mitigate them. Relying solely on stocks leaves you vulnerable to significant losses in the event of a market crash. To safeguard against such risks, investors strategically diversify their portfolios, spreading their investments across different asset classes to reduce overall risk exposure. Research consistently demonstrates that while stock market returns can fluctuate dramatically in the short term, stocks tend to outperform nearly every other asset class over the long haul. Even during periods of significant market turbulence, when it seems like the sky is falling, it's important to keep the big picture in mind. Over extended periods, even the most substantial market downturns appear as mere blips in the market's overall upward trajectory. Maintaining a long-term perspective allows you to view major market declines not as threats to your financial well-being, but as opportunities to enhance your wealth. Instead of panicking and selling off your holdings during bear markets, astute investors recognize the potential to acquire high-quality stocks at attractive prices and valuations. Moreover, in the event of a looming stock market crash, is it advisable to sell off all my stocks and await a stabilization period before reinvesting? Navigating the market timing strategy might seem straightforward in theory, but in practice, it's a challenging endeavor. Successfully executing this approach requires precise timing on two fronts: deciding when to sell and when to repurchase your positions. Opting to liquidate all your holdings and transition to cash entails the risk of potentially leaving money on the table if you make your move too early. When it comes to re-entering the market, the process of bottoming out typically unfolds amidst a barrage of negative headlines. This environment can lead to self-doubt and hesitation, potentially causing you to delay your re-entry into the market. Consequently, you may find yourself on the sidelines for an extended period, missing out on significant market gains. As seasoned investors often emphasize, the key to successful investing lies in time spent in the market rather than attempting to time the market's peaks and valleys. Ultimately, trying to predict the market's best days is an exercise in futility, as they are inherently unpredictable. Missing out on these opportune moments can severely impact portfolio performance. Therefore, it's essential to adopt a long-term investment approach, focusing on staying invested through market fluctuations, rather than attempting to time them. Next question to answer: in times of market crashes, do bond prices typically rise? Typically, but with exceptions. When the market takes a nosedive, certain bonds tend to perform better than others. Government bonds, such as U.S. Treasuries, often emerge as top performers during these turbulent times. This is due to the flight to quality phenomenon, where investors seek refuge in safer investments amid market uncertainty. On the other hand, riskier bonds like junk bonds and high-yield credit may not fare as well during a market crash. These bonds carry higher levels of risk, making them less attractive to investors seeking safety and stability. While government bonds like U.S. Treasuries may see gains during market crashes, it's important to consider the broader economic context and the specific characteristics of different types of bonds when evaluating their performance in turbulent market conditions. Is it advisable to invest in the stock market if I plan to use the funds to purchase a house within the next year? Absolutely not. Investing in the stock market is most effective when approached with a long-term mindset. While the allure of short-term gains may be enticing, especially during a bullish market, it's crucial to recognize that markets can be highly volatile over shorter timeframes. If you're considering investing in stocks with the intention of using the funds for a house down payment within a year, it's essential to proceed with caution. During periods of market downturns, you run the risk of having to liquidate your stock investments at an inopportune moment to access the necessary funds. This could potentially result in selling your investments at a loss, jeopardizing your financial goals. Therefore, when it comes to investing for short-term goals like purchasing a house, it's generally best to opt for more stable and predictable investment vehicles to safeguard your funds and ensure they're readily available when needed. Understanding what actions to take when stocks experience a downturn is paramount, as a market crash can have significant mental and financial repercussions, especially for those new to investing. Engaging in panic selling during market declines can actually harm your portfolio rather than benefit it. That's why it's advisable for investors to resist the urge to sell during bear markets and instead maintain a long-term perspective. To navigate market downturns effectively, it's crucial to have a deep understanding of your risk tolerance, investment horizon, and how the market behaves during periods of instability. One useful tool for assessing your risk tolerance is to experiment with a stock simulator. In essence, successful investing requires patience rather than panic. By remaining calm and informed during market downturns, investors can position themselves for long-term success and weather the inevitable ups and downs of the market with confidence. Thanks for tuning in to Everyday Elevate. Remember, when it comes to navigating stock market downturns, staying cool, calm, and collected is key. Don't let panic selling shake your confidence. Instead, focus on the long term, understand your risk tolerance, and diversify your investments. If you're new to the game, try out a stock simulator to hone your skills. And always remember, patience pays off in the world of investing. Subscribe now to Everyday Elevate for more tips and tricks to elevate your investment game. See you in the next episode, and happy investing.